people don't seem to understand the benefits of home ownership. And there are so many. Majority of people out there right now are first-time home buyers, or they don't currently own a home and they're renting. And you guys, we live in the state of California right now where rent is sky high, and nothing is taxable. Nothing is taxable. So we want to dive into that issue that people are having of, do I buy right now? Do I sell? Do I list? What's really the benefit? Because rates, oh my God, they're so high, but realistically, they're not. It is all about strategically planning and putting something in place for that homeowner. And I felt Natalie was the best person to talk to about the benefits of home ownership, because there is zero value in renting. Zero. Okay. Real estate report card. If you're not following my social media, please go in and follow it. Lone Girl Rissa is my business page, or it's with a Z, Marissa K, my personal one. You'll get all my goofy videos that I post, but I post every month a real estate report card, and I can send this out to you whenever you want to, for you to kind of see what is happening in the counties. I've been following this for about 2.5 years. Every single month, I pull this report card. I pull it for my agents to even go door knocking to help educate people on what's happening in the real estate market. And you guys, what's happening is values are increasing. They're not going down. We are not seeing a decline. And that is because of the lack of inventory, right? So what is happening over just Sacramento County alone, 7.3% increase in property values over the next 12 months is what is anticipated to happen. That's huge. So do you buy right now? Yes, you do. Are rates high? Yes. Is there a solution for that? Absolutely. And there's tax deductions, and we're going to go over those. So let's dive into those tax benefits. Natalie, tell us a little bit about you, sweetie pie.
Hey everyone, glad you guys can join us tonight. Again, my name is Natalie. I am the CEO and main tax professional at Inley Taxes, and I've been in the industry for about 12 years now, going into my 13th tax season, and I've had the opportunity to work with all sorts of amazing clients at every different point of their life, from military to entrepreneurs and business owners to moms and dads to first-time home buyers, and then, going through that journey myself of becoming a first-time home buyer a few years ago. These were all of the things that I wish I would have known then, that I now know now, from a personal standpoint. So I like to kind of share, because I know a lot of folks are trying to understand the tax law. And like you said, Marissa, does it make sense to buy? Does it not make sense? Some folks say I can deduct things. Some folks say it gets me money back. What does that all mean? How do I implement that? Does it work for me? Et cetera, et cetera. So I'm hoping to answer all those questions for you guys today. And then, of course, at the end, if you guys have questions, please ask. I'd love to answer all of those things for you.
That's awesome. And you guys, guess what? Tax laws change how often? Every
Every
4 years.
day?
Definitely
Every
every 4
year.
years.
Every
And we
year.
are coming up on an election year. So who knows
Yes.
what's going to happen? It's going to be insane. I'm always excited during an election year, because it's like, I'll tell you what, I used to owe every single year. And now I'm not owing as much as I did. And, I typically vote Republican Party. But I don't know. Some of the tax laws that they come up with, that they're coming up with, are saving me big time. And I appreciate that. Definitely appreciate that, being an entrepreneur, you guys. So I'm excited to hear what you have to say about that, especially in home deductions, because everybody works
Yes.
from home now, almost still. So let's get into it. JC, can you move that slide?
All right, so let's start it off. Okay, so this is the thing that everyone gets excited about. This is the main conversation. Does owning a home mean write-offs and a lower tax liability? And it's something to really think about. And the answer to that is yes, if you do it correctly. And it's all about having a good understanding and a good foundation of making wise decisions when it comes to purchasing a house, and know what your financial situation is and how it will impact you. So the answer is yes.
And this goes down, you guys, based on from the time that you write a contract to purchase a home, believe it or not, because there are benefits when you write a contract. If you do not have certain closing costs, or when you're asking a seller to pay certain items, if they're not listed correctly on your final closing disclosure, that final disclosure goes to your tax accountant, which does all of your write-offs. And if things are not put in the right area, well, that can be an issue, because that means you're not getting your write-off. And guess what? Agents, if you're, or as a listing, sellers have closing costs just like buyers. So it matters when you're a listing agent and you're looking at a closing cost statement. How is this going to benefit your seller? How is it going to benefit your buyer? That matters. And that sets you apart as far as knowledge from any other agent when you're actually going out there and you're looking and you're doing your meetings with your buyers, because those are the extra intricate details that normal agents don't pay attention to. You want to save your clients as much money as possible. And it's important that you guys are looking at the closing disclosure before your seller is buying, closing escrow on that home, before your buyer is closing escrow on that home. Are things listed where they're going to get their maximum savings, right? I'm going to give you a good example when we talk about points and fees and all that in just a little bit here. Go ahead.
Yeah, next slide. Right. So I'm glad you mentioned that, because that is my number one. It's the very first thing I have listed when it comes to maximizing your tax benefits. It's keeping the proper records, maintaining those accurate records that identify specifically what mortgage interest you guys are paying, what property taxes a client might be paying, and anything related to home office expenses. It needs to be accurately documented so that you can deduct those things. So regardless if you're a seller, a buyer, or if you do real estate in the business aspect as an entrepreneur, buying, selling, flipping, wholesaling, any of those things, all of these expenses still have tax benefits as long as they're itemized and related to that specific property that you are going to be claiming on your taxes. So keeping records is huge. The next
Question.
thing is, oh, go
Question.
ahead. Yes.
So
Yes.
home office expenses. This is one thing that I feel when I see, because I do a lot of loans for, well, W-2. I'm a W-2 wage earner, believe it or not, right now. And I have a home office. What are types of things that you can write off as far as a home office expense?
So home office expenses, unfortunately, is related to 1099 or self-employed
Mhm.
business owners or entrepreneurs. It is not related to a W-2 person. So if you are a W-2 earner and you have to utilize your home office, your employer should be reimbursing you a stipend or something for that space, equipment, and etc. If they are not, that's something you should negotiate with them, because you're using your own personal resources to provide yourself a work environment that they are dictating what you do and when you work. So the actual tax deductible home office expenses on the federal law is related to business owners
Okay.
and entrepreneurs, tax professionals, real estate professionals in that capacity.
So if I'm a W-2 wage earner and I'm in some sort of sales field, I can utilize a 1099 business and write things off that way, right?
Yes, as long as you have that business, yes.
Awesome. Cool. Okay.
So definitely understanding the tax laws, because they do change frequently. Every couple years, as you mentioned, it does change. Like we once were able to write off mortgage insurance premiums. Currently, that is no longer. So just knowing that and how that may impact you year by year is important. So that's just something to keep updated on. Energy efficient investments, that is a huge thing, especially in the state of California. When it comes to solar, when it comes to appliances, or repairing or changing out water heaters and HVAC, et cetera, windows, and all of those lovely things that we do that goes along with home improvement or whatnot. They majorly have some kind of tax credit. whether you're improving your home, whether you're repairing your home, or whether you're building and adding on, there's typically some type of energy efficiency credit that is related to a tax deduction. And you just want to make sure when you go out to make that purchase that it qualifies. You may have to spend a little bit more money on the front end, but a lot of those are 40 and sometimes 60% of your expenses you get to write off over a few years. So it's definitely worth taking a moment to look into it and see if you can deduct those energy efficient improvements and investments.
And here's a huge benefit to that. Guess what, you guys? There is a such thing as an energy efficient mortgage, and you can get up to 5% of your value of your home finance for energy efficient improvements. So all of those fun things that she just listed, the HVAC, all that fun jazz that like can cost thousands of dollars, you can finance into your loan when you go to purchase your home. And guess what? It's a tax deduction if you do so. So definitely want to look into utilizing specific programs like that and really understanding and knowing if you're making your home energy efficient, there's programs that are going to give you additional tax credits as well. And there's even grant programs that they come out with all the time, especially if you're a veteran, they have those. So little tidbit there.
That is awesome. I didn't know that last piece, so we'll definitely have to talk about that.
Yeah.
So the last, or I guess the last for now, major tax tip is planning for rental income. If you're using your home or a home for rental income, just to forecast what that'll look like for you for the year. Regardless of the income amount, just taking that into consideration and understanding if you're going to have income that is going to be reported after all of your mortgage expenses, who you pay to maintain the home, all of those different benefits that you get to have. So let's kind of just think about rental income in this way. If you have a primary resident a primary residence or a secondary residence that you're using for rental property, and you are paying someone to maintain the landscaping, maybe you include all of the utilities in the rental agreements that you have for folks, and they're just paying you one thing. Every expense that you have related to maintaining that rental property is a beautiful tax deduction, which is really nice because if you live in that primary residence, there are only certain things you can deduct. But when you, hold on, this popped up. But when you are using it for rental income, there are much more tax benefits that you can utilize with your rental income and with that rental property. So you want to look and forecast what's the intent and what's the use going to be for the year. Are you going to stay there? Is it going to be 100%? Are you going to be there just a few days out of the year? There are different scenarios that allow you to deduct different levels of tax deduction. So you want to know going into rental property what your intent is with that property so that you can properly keep records and maintain if you are living in that property, if it's short term, long term, etc. You want to think about those things when you get started, not at the tail end.
Okay, and if you guys have questions, definitely drop your questions in the chat because we are going to go back and we're going to answer all of your questions that you guys have after this webinar is over. I wanted to talk to you a little bit about that income, because we as lenders, we are allowed to utilize rental income to help you qualify for a mortgage. So if you're a first-time home buyer and you're purchasing a duplex, then we can utilize the rents to offset your payment. Now, here's one thing that a lot of people ask me though. Oh, Marissa, I've got family that lives with me and they pay me $500 a month rent every single month. My question to them is, do you include it in your taxes? They don't. And if they don't do that, then we can't utilize that money as income. So if you have a client or if you are an agent and you know that you are preparing your clients to be able to qualify, we have families in California with the prices being so incredibly high and rates being higher, payments just not being affordable. Families are purchasing together and they're living together. So you want to educate clients to include that income into their taxes when they file, because we're able to utilize that income to help them qualify for a home when they do go to purchase.
Yeah, that is really, really important because in order to deduct any of those expenses and have that tax benefit, you actually have to have proof that you had the rental income. So whether it's a lease agreement or you have records and receipts, you have to have that income and report it on your taxes, like you said, before you can even think about deducting anything. So that's why it's really important to have everything accurate on the front end and not
Mhm.
look at it at the back in because that gets in a really messy situation and get you in a lot of trouble.
Absolutely. And typically, you guys, as far as income, when we're utilizing that to help you qualify for a loan, they require 2 years. But in some circumstances, when we run our automated approval system based on the client's profile, it will allow for only 1 year. So it doesn't have to necessarily be 2 years. 1 year can suffice dependent upon the client financial situation. So the best thing, get the application in, let's look at it, let's see if we can qualify them. If say right now is a great time to prepare for home ownership the beginning of 2024. We look at the income. I'll run the scenarios based on that roadmap for home ownership journey towards next year. If they're just not ready right now to say, okay, you need to file X amount of dollars with your tax accountant so that you can qualify for more of a mortgage the beginning of next year when you're ready to start putting that in. And that is a great way to prepare for home ownership for the future. Okay. But we always want them to talk to us and let us educate them and educate you on exactly what needs to happen. Because I mean, $500 a month is a huge increase in qualifying and benefit for you if you're filing that on your tax returns. If you have family living with you, it's easy to put a rental agreement in place. Or if somebody's living with you renting a home, put the rental agreement in place. And you can always do, if you don't qualify for that 12 months, I mean, how could they qualify to do, and they've had them for 3 years living with them? It's as simple as doing, what's that word again? Where they change their taxes? Uh,
Amendment.
Amendment. There you go. Amend your taxes. You guys have the
Yes,
ability to be
yes,
able to do that. And so, always getting a second opinion matters in those types of situations because we want to be able to help you do things that are going to save you money in the long run, but also help you to qualify for home ownership. Okay.
yes, yes. Next slide. All right, so let's talk about some of the pros. Some of these are commonly known, but I just want to make sure we go over them and none of them are skipped over. So, the mortgage interest deduction is one of the largest tax benefits and one of the most commonly home tax benefits. And that's basically any interest that you are paying on that mortgage every single month. At the end of the year from your bank or your mortgage provider, you're going to get a 1099 statement that or a mortgage interest statement that's going to break down every dollar that you paid in interest towards that property loan. And that is a huge, huge, huge tax deduction, especially with interest rates on the rise at the current moment. Every additional dollar that you pay, you are going to get a tax benefit back when you file your taxes because you now will be able to deduct that. Okay. Also, on that same
Guilty.
statement, okay.
I'm guilty. I use TurboTax, and this is my very last tax deduction that I put in because I always owe Uncle Sam a ton of money. And then I just go bloop, 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 bloop. The last 2 years, I haven't owed him. So, yay.
And it really makes a difference. It really makes a difference. I haven't seen any mortgage statements yet for 2024 or 2023 for 2024 filing season yet, right? We aren't there yet. But for previous years, it's typically close to a third of the mortgage that is paid over the first few years, just kind of
Mhm.
dependent, it fluctuates a little bit, that is going towards this deduction. So just imagine a $3,000 mortgage payment every month, having roughly $1,000 of that going towards a mortgage interest deduction at the end of the tax year. That's a $12,000 deduction that can potentially help lower your taxes. So when you look at it that way, you're not
Right.
really paying more, you're paying into your future. So
Right.
that's a huge benefit there. One of the other things you see on that same statement is typically your property tax deduction. It may be separate, but typically it is on the same statement because many people pay their property taxes or in their real estate taxes in conjunction with their mortgage. So you will see both. You'll see some variations depending on what county you live in, what state you live in, etc. But
Do you
that is also
and tax, this is important because do you know how, I mean, I look at, 4 or 5 tax returns a day. And do you know how many people that own homes, they don't have their property taxes listed on there as a deduction? Like who
oh
you work with matters when they're doing your taxes. And, if they're doing TurboTax, guilty, then, you're not getting the maximum amount that you need. So these types of things are huge because it's not going to affect your income. It's not. It's for qualifying purposes of a new home, but this is your money that you're giving away that you could be writing off. And I see it for investments. And I also see it on their personal tax returns that they're just not utilizing and taking advantage of their tax benefits.
yes, and that's huge because, in a similar scenario on that person who's paying roughly 3,000 in mortgage, depending on the value of their home, they're paying anywhere between 4 to $7,000 in property taxes a year. Of course, it changes a little bit, but just between those two, you can have anywhere from 15 to $20,000 in tax deductions for your home alone, right? So it's really important to make sure that you gather those documents, you ask questions about them. If you don't see those numbers listed on any of your clients' documents or your personal documents, that you start digging, asking questions so that you can find that information because it really does make a benefit and a huge dent into your tax bill. Um, and when it comes time to selling that property, right, that capital gains exclusion is really, really nice. With the value of everyone's homes going up, single individuals being able to exclude $250,000 of profit from the sale of that home or $500,000 for those married couples. That is really, really a huge and significant tax benefit and savings alone. So let's say you purchased that home a few years ago and you got it for 400,000 and you sell it, this year for 650 without any of the extra deductions and things that go along with that, 250,000 in your pocket cash potentially without having to pay any taxes on that. And that's a huge, huge benefit if you meet this specific criteria of living in that home and a few other things. But that's a huge benefit. Where else can you make that amount of money and not
Yeah,
have to pay taxes on it and can repeat that cycle over and over again if you
that's
plan it
awesome.
out properly?
I get a lot of questions. People just don't really understand capital gains. So Natalie, I would say call your tax accountant. Can you help me out here? Like, can
Yes,
you dive into this right now and really understand? Because this is a huge deal when somebody goes to purchase a house or sell their house, right?
yes,
Understanding
yes.
when and how long and when, what do you explain it?
Yeah, it's really important. And sometimes folks even forget how much they purchased it for if they had it for so long, right? So it's important to keep those records for that as well, because that's your cost basis. That's the starting point that we look at when we look at the beginning price and the selling price. And it goes both ways. So it's just really important to keep those documents, anything related to the purchase and or refinance or potential sale of a home. So next slide. Okay, so um, home office deduction. So we kind of talked about that a little bit before today, but I want to break this down for our business owners or even some of our real estate professionals here. Having that home office space that is set apart, okay, and it has to be solely used for that business for office. So here's an example. If I have a room in my house that has a sofa sleeper in there and I have an office desk in there and I use it for business 99.9% of the time, but the one weekend a year my family comes and they stay in that room and I'm using it as an extra guest bedroom, that is now no longer considered a home office because you're using it for other purposes. So I always tell people, look at that space as if you were renting that office out of a business. You wouldn't go there and stay there for the weekend. You wouldn't invite your family there. You really need to treat that as your like it's your business
Right.
office. You know, you go in there, you spend 10, 12 hours if that's what you're doing, you leave and you lock the door. Everything in that room
Mm-hmm.
typically is a business deduction. All of your business equipment, computers, printers, if you're doing t-shirt business, all of that you buy equipment wise and to maintain that building is now a deduction. If you're painting that room to resemble your business colors and you have murals, etc., you have cameras and lighting, all of those things that are in there are part of your business and it goes into your home office deduction. So when it comes to utilities and maintenance and that kind of thing, it's a percentage of the home. And that is normally the most beneficial way to deduct the home office deduction. So a quick example, you have a 2,000 square foot home, and let's say that room is 10 by 20 that you're using as an office, 200 square feet, it's 10% of the home. So 10% of the utilities, 10% of the maintenance, the water, the sewer, the insurance, 10% of every bill that goes to that house that relates to the business as well is now a business office expense under the home office deduction. So that
That's
can be a nice benefit.
that's
Okay.
really good. And that's how I'm set up. I have a home office that I work like pretty much 98% out of. And it's just my little home office, no kids, you're not allowed in here. That's it. This is my spot, everything real estate related. Get lost. You're not allowed to do anything other than sweep the floors. You can definitely sweep the floors if you want to.
Put them to work. That wasn't part of it, but put them to work. That's also a huge tax benefit too.
Yeah.
Another topic.
So energy efficient tax credit. I know we talked a little bit about some of these, but let's dive into these a little bit more. We're seeing more and more people doing solar, right?
Yes.
So how is that really a tax benefit for a home buyer? Most homes have solar now, especially if it's a new home subdivision, they're required to have solar. So,
Right. So the purchase of the solar panels, some of them are 100%, some of them are 40, 60%. It just really depends on the county you're in and the company that you're working with, right? So um, typically anybody you're buying solar panels for are going to tell you what that credit is up front because they know if their company is qualified and they know what type of solar panels that they're installing, how many backup energy batteries they kind of have to store that, and all those things go into it. But what it does is it reduces your tax burden dollar for dollar. So let's just say in your tax scenario, without this credit, you would have let's say a $6,000 tax bill, and you just put $25,000 worth of solar panels on your home. So now you have a credit of $20,000 worth of credit that lowers that tax burden. And what it does is it reduces that tax burden to zero, and the remaining energy efficient credit rolls over to the next year. So you reduce your burden to zero. And let's just say out of your W 2 or other income forms you've had some taxes taken out of, that now becomes your refund. And that remaining money that you didn't get to deduct from your solar panel carries over to the next year. And you get to kind of keep eating away at that year after year. So it's really a right now savings, but you get to spread it over a few years because typically you don't have a huge enough tax burden normally to enjoy the solar credit all in one year. So that is a really nice benefit. Now, what it is geared towards specifically is equipment and supplies, etc. It does not include the labor. So they will normally separate those two fees on your energy solar system statement. So the labor, that's something you got to pay for, but the actual equipment, maintenance, and all that other stuff is actually going towards a solar and energy efficient tax credit.
okay, so as somebody who's purchasing a home,
Okay.
they already have the solar on there. Now, what's the difference between purchasing it with it already being on there and then leasing it
So
for,
if you're leasing it, you're renting it. So you
right?
don't get to get that credit. And
Right.
I would avoid leasing it if you are looking for the tax credit because you no longer get it. That is still owned by the solar panel or energy company, right? They can come remove them, et cetera, if they see fit. Now, if you're taking over a purchase of a home that already has it in, and you have the option of having that solar panel, I guess, loan,
Mhm.
kind of blended into your loan,
Right.
or you can take it over separately. If you take it over separately, there's some paperwork that has to be done in order for you to take over the remaining tax credit that has not been deducted. That gets really sticky. So most people just kind of roll it into loan with the program that you mentioned earlier.
Okay. Okay, that's really good information because a lot of people think they're going to get all this huge tax savings, but most people have the solar panels and stuff on already. So, you're going to get most of your deduction if you're looking to go solar. But at the same time, you really have to look at the cost and evaluation of everything, including what your tax saving is going to be, because solar panels are only good for about 20 years. So, that's something to think about. You really need to do the math. So definitely, if you're thinking of that, or you have a client thinking of that, call Natalie about it before having that client make that decision so that you can do the math. Does it make sense, especially in the county that you're looking with, based off what your energy is? And I'll give you an example. I looked at doing solar for my house, and I with Spud. I live in about a 2,400 square foot home, and my home is I only pay about $350 a month. And during, these next 2 months, my bill is about $450. So it's not the difference in solar, the cost of taking out that loan, it was pretty much the same. So it didn't make sense for me to do it. I was just like, why am I going to have all that ugly stuff on top when I know I could be more energy efficient, but at the same time, does it really make sense with the tax deductions? And it didn't for me. So solar is not for everyone. It's definitely, you want to weigh out the pros and the cons of it. Okay. And you need your tax accountant to be able to do that because you don't know what you don't know.
That is true. That's really important, especially because it really depends on what you're income in as well. Even if you get that amazing credit and it saves you $100 a month, how long
Mhm.
is it going to take for that credit to weigh out over time? For
Right.
you to actually see that, because your tax burden may be low depending on your filing status and your situation. So it is really important to consider that before you make that big purchase. Now, one of my favorite things, and it's commonly overlooked, is prepaid points, interest buy downs, all those lovely things that real estate lenders get to work with clients to make getting into a home really happen.
Right.
But sometimes those are not captured on their statements properly, or it's not even mentioned and given to their tax professional to save them some money. So it's really important. Those points and those interest buy downs are equivalent to the dollar of the property taxes or the mortgage insurance premiums. It's calculated very similar. So every point, every interest buy down really makes a difference, especially if you're prepaying those on like a refinance or something, that you want to make sure you capture those along with your standing mortgage and taxes that you're paying. So do not forget about prepaid points or interest buy downs or all of those things that go along with refinance. That is commonly looked over. And let's say you missed it or you hear about a client who missed it, they can always go back and amend those taxes for the previous 3 years. So they have a little bit of time, but they don't want to wait too long because those 3 years sometimes fly by quicker than they realize.
If you are a listing agent, this is huge because you're looking at offers and you're taking the highest and best offer for your seller, right? And so right now, the biggest thing is that 3-2-1 buy down, right? Those temporary rate buy downs, which is amazing opportunity for a home buyer, but they need a seller to pay the cost of that. So if they're writing in the contract, seller credit of 3% towards rate buy down, or a seller to pay closing cost of 3%, they are not getting the tax deduction. Your seller could actually get a tax deduction if they specifically state in the contract that that 3% is going towards an interest rate buy down. They are prepaying interest for that amount of time, and that's what those monies are allotted to. And so since interest is a tax deduction, that's the tax deduction for your seller, right, Natalie?
Yes, yes, yes,
Yeah, yeah.
yes.
Seller.
And that's huge.
So how you're accepting an offer really matters as well, because even if you're a buyer, my buyers, they want to save the seller money too. They're not out to gouge, but they need help. So if we could help each other, that's even better all around, right? So and where you're putting that those matter on the closing disclosure. So for me, the one I have to look at a closing disclosure before my loan docs go out. I need to see that everything is in place so that when, if I'm negotiating and I'm telling my buyer's agent, hey, or the listing agent, this is going to be a tax credit, because most agents don't know that. This is a tax credit for your seller. Make sure that they understand when you talk to them that this is a tax credit for them and it's going to be on their closing paperwork and they need to pay it. This is also a great opportunity for you to touch base in January or December with your client to say, hey, guess what? You bought a house this year, or you refinanced this year, or you sold your home this year. Get your closing paperwork together. Make sure your accountant has it. You want to make sure that they're getting the max of their deduction, and you really care about that. We care, especially in California. Everything's just so expensive. We want to save people as much money as possible.
Yes, yes. And that's really huge. I do get a lot of first time homeowner tax clients that say, I
Right.
bought a home last year, and they mention it, at the very last of our conversation. I said, wait, 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 we are nowhere near done. I
Right.
need these documents. What did you do here? What did you pay there? And they have no clue that they can deduct them. So it is really, really important that during that purchasing or selling process, that those documents are kept and set aside so that they're readily available at tax season, especially for folks who are selling throughout the middle of the year. They kind of forget about it, right? They kind of wash their hands of the home. They're all excited and everything, and they forget to include those expenses as well that goes with selling the home and part of their tax deductions and their tax filings. And that makes a really big help, seeing that they only own the home for a portion of the year. So their deductions will be a little shy than normal, but this will make up for it and sometime over exceed what they would typically pay throughout the year.
Perfect. Awesome.
Next slide.
What's next?
All
Cons.
right,
Oh,
so I hear about this, and this is really the only thing. Depending on your income, for the really high income earners, you may have alternate minimum tax that, kind of applies. Those are for those folks who typically have CFOs and accountants on staff that kind of handle their annual incomes of more than 500,000, and they have a different tax scale, and there's some other implications to home ownership. But if your income's getting there and you're looking into dabbling into real estate more, that's definitely something you're going to want to look at, just because the tax rules are a little bit different. But that's the only thing I really wanted to hit on AMT.
yeah,
Next
yeah.
slide.
But this is all how, you file your taxes, especially if we can get rid of some of that and lower it under that $500,000. Right?
Yes, next slide. All right, so we briefly talked about this, but it's important to talk about the tax on rental income. And this is why I mentioned earlier on that it's really important to know in the beginning to decide how you're going to rent out that home, because there are some income that needs to be reported on there. If your expenses, let's say, you got that mortgage 10 years ago, and let's say you're paying a lovely $1,500 a month on your mortgage, and you're able to rent that thing out for 25, 2,800. There's some income on that property even after expenses that has to be reported, and that can be a great thing if you're trying to show more income for purchasing another home or doing some investments, et cetera, et cetera. So you just want to keep that in mind, that yes, there are many tax deductions for owning a home, but there may be a little bit of additional tax if you're making a grand profit throughout the year, if you're using it for rental purposes. So just keep that in mind. Um, the capital gains tax, we talked about that, but let's just say it's over that huge exclusion amount of 250,000 or 500,000. There may be an additional capital gains tax for investment properties on there, and even some primary resident homes. Based on the amount that is over the exclusion, or if you did not meet the time frame and criteria for owning that home as a primary resident. So if clients are talking about, just staying in a home from a really short amount of time and they're wanting to sell it in, let's say, a year or so, this is something that they would want to talk to a tax professional about, so they can go ahead and look ahead at what those capital gains taxes will be. And it's going to be different than the normal income taxes. So that is something that just has to be considered, and that's why it's really important, if folks are planning to buy and sell quickly, or if they're using it for other intentions besides a primary residence, just to consider what the tax implications is. And there's a variety of them. I'm not going to cover them all, but it really depends on their personal intent and what they plan to do with that home. But there may be some additional taxes for capital gains there. Next slide. All right. So that is the overview that I have for you all today. I didn't want to dive too deep, and I only wanted to talk to you guys about what is truly important to you guys and what really benefits you and your clients out there. But right now, I guess, Marissa, did you have any questions or things you wanted me to cover?
Yeah, I did. There's been can you talk a little bit about casualty and theft losses? I know that that can also be a tax deduction. I don't know too much about it. I haven't heard of it. It's like for me, my house flooded and I had like, almost $20,000 in expenses.
Okay.
Also, I just replaced my well and there's a bunch of other stuff that needs to be done. Are those things tax deductible as a homeowner?
Yeah, so some of them are, and it really depends on the scenario around that loss and or that theft. So let's just start with the most common one that we see, and California experienced it this year, was the national disaster from all of the rain we had earlier this year. So a lot of folks had losses to their home and a lot of damages to their properties. Certain counties were identified, and FEMA actually identified it and gave numbers, like a tracking number that says this is a natural disaster and that you'll be able to deduct those losses related to that, right? So if you were impacted by that, I would just look up in the county, look online for FEMA disasters in California. If your county or your neighborhood is identified, make sure you grab that FEMA number. So when it's time to file your taxes and you have all of those expenses related to the loss of your home, you will be able to deduct fixing your home back to its pre-existing
Wow.
value or standard, long as you have that FEMA number that identifies your address in that area that was impacted. So you have to have been in the impacted area. So for us, I know Lodi, Stockton, Galt, there was a huge area, a whole community there that was underwater and flooded. That whole community, when it goes to replacing their homes or taking it as a complete loss, they have that number and their address is a part of that identified area. So they'll be able to write that loss off. And that is a huge benefit. And where that casualty loss goes is on the actual Schedule A or itemization. So it doesn't matter if it was a business property or a personal property, but it goes onto your personal 1040 taxes and it goes into the same category or the same schedule that calculates like charity donations, your mortgage insurance, I'm sorry, your mortgage interest, property taxes, real estate taxes, huge medical expenses. So it goes in that same category. So it gives you a much bigger benefit of writing it off than if it was in a separate category alone.
So yeah, so Jamie, yes, on mobile homes, that would be, I mean, it's not considered real property, but it is personal property. So that is considered.
Yes.
Here's a good question for you because, it's like I had my family's home burnt down in that huge fire where the entire city was burnt down a few years ago, 5 years ago. I didn't realize that. Is this, how far back can you go to amend your taxes to have something like that changed?
So you have 3 years. You have three tax years from the date that the filing was are expected to be done. So April 15th is typically the day. It kind of varies. Recently it's been April 18th, right? So right now, let's just say April of 2024, you would be able to do 2021's tax season because it would have been due in 2022. So then you have 20, oh, okay, I'm sorry, 2020 tax season because it would have been due in 2021. So 2022, 2023, and 2024 would be the deadline. So all the way back to 2020. Now, when it comes to like fires and those type of things, theft and whatnot, you're only able to deduct what the insurance does not cover, right?
Okay.
So typically there's some insurance they will cover up to a certain amount. So let's say they cover 80%, 70% of it. The difference that was still spent, that is what you will put on your tax return as a loss. And of course, they would want proof, et cetera, of all of those things, which you would have as you go to rebuild or replace or et cetera. So, yes.
Okay, that's awesome. Here's a question for you. When I'm actually Jamie's on here, she's an investor and she's a real estate agent. But what are, versus somebody just writing it on their schedule, real estate schedule E, right? Um, what somebody who has multiple properties, what is the best way if they're an investor to maximize in their tax benefits?
Ooh, so there's a there's a couple different ways, right? And it really depends on how you're set up, and I'm not gonna say how creative you get, but how structured you are, right?
Yeah.
Um, so typically you will have a Schedule E for every single property. So every property and all of the expenses, upkeep, property management, all of that goes into a rental property, right? Buying, flipping, all of that good stuff will be kept separate. And one of the biggest things is having a separate bank account for each specific property. So there is never any confusion or never anything with the IRS if they come in out of your books and say that you were commingling funds from personal to business or from property to property. You want to keep it separate. Do all of your business for that property. Once you're done with that property, close that account, open a separate account, and keep everything separate. That's
Oh,
really important to keep all those transactions done. Now, of course, you may transfer money between accounts, but that shows, a loan or an investment, et cetera, right? You feeding into your business. So that's one key tip. The other thing for real estate investors or professionals, right? There's this hour limit, and I can't think of it right off the top of my head. But there's amount of hours that have to be put into in real estate professionals to be able to deduct it as uh, passive income. I'm sorry, active income versus passive income, which when it's active, you are able to deduct a lot more and you're able to take active losses at a higher percentage than if it was passive income, meaning this is something I did on the side with flipping houses. You won't be able to take every loss dollar for dollar. To lower your tax liability as if you would if this was active investing. So there's some rules there. I can definitely get you that information, but I don't remember the amount of hours off the top of my head that is required. But if you're truly doing this full time, it's easy to make those hours.
yeah. JC, can you do me a favor and drop her Instagram contact information in the chat so that people can connect with her? This is fantastic information, especially for investors, because this is huge. I have a client right now. I just looked at 3 sets of tax returns. Oh my gosh. His personal, he does a termite company and he is a investor in real estate. He has 2 investment properties that he does Airbnbs from. And so he opened up an LLC a year and a half ago, which, his tax savings is huge. The amount of tax savings that he had, I mean, his loss was like 89,000 on paper, but after depreciation was
Appreciation.
added back in.
Yes.
Sorry, I had too many energy drinks today. I'm a little fluffed. The depreciation was added back into it. You guys, he was only negative $800 a month on just that portion. He was still positive $17,000 a month in his income, and he qualified for $1 million property. So it's like how
Yes.
writing these types of things off as an investor's matter. So definitely hit her up. Her Instagram is in there. Click on it, and she has her contact information. What's the best way to get a hold of you?
The best way during non-tax season is through email, right? Email and or my Instagram. I monitor it. My assistant monitors it 24 hours a day. Typically get back to you within a couple hours. If you'd like a phone call, there's a link on there as well that we can schedule some time. There's some ebooks for business professionals on there on how to kind of structure that first LLC, some things to think about and consider. So there's some free tools for everyone there. But Instagram, email is the great way, and we can always schedule a time to talk about your specific situation because taxes is a really personal thing and
Yeah.
it is different for every single body based on what you want to do and what you are trying to get out of your financial situation. So I like to personalize my responses to help you personally.
Yeah, you tax accountants, y'all have a bad rep. And when tax season comes around for me, I'm like, last minute, right? But have the conversation because these are the types of things like you don't know what you don't know. And trust me, boom, my mind has been blown by the amount of things that I didn't do in the past just because I didn't want to pay because I thought that I had to. I thought I knew everything and I didn't. So she is now my tax girl. I'm very happy to introduce you guys to her. She a CPA. CPS, you do CPS? No. Jamie.
Whoa. No.
CPA. I had somebody else ask this question today. They
Okay.
wanted to do CPA work, and I told her, go ahead, you fill out what you do.
So I am not a CPA. A CPA, the difference between a CPA and what I do is a CPA went to school for accounting and then became a tax professional. And they typically kind of do that on the side, and it's more of a overall financial picture thing. My focus is strictly taxes, and of course, tax law. So I've been doing this for 12 years. I've been doing it for the military. I've done it for personal. I've done it for business. And I've also taught for the IRS and the state of California curriculum courses. For you that may not know, California and New York are the most stringentest states in the US, and it requires additional certifications and bonding every single year. So I'm required, and I also love to do tax conferences and stay up on all of my continuing education. So my love is taxes. It's not something I do, it's something I breathe. And if I don't know it, I know someone who does know it. I have a community of
Exactly.
over 1,000 tax professionals that I meet with quarterly and monthly, and we talk about all of the new tax laws changes and how we can help benefit our clients. So I am not a CPA, but I am a seasoned tax professional. And I would love
But
to
she
help
does
you if you
have
guys have
somebody
questions.
that, yeah, she does have somebody she can refer to that she's worked with that, is qualified. She did give me that information too. I forgot.
Yes, yes. So
Um,
if there's something that I'm like, this is better for a CPA because you have a lot more going on than some tax situations, I have some folks that can definitely work with you that I work closely with. Yes.
Yes. Well, thank you so much. I really appreciate you coming on and having this discussion. Thank you everybody for joining the webinar. If you have questions, reach out. No question is silly. Trust me. We're all about finding the answers to help you be more successful and more educated in making these decisions and to help educate the community more. Okay. Because
Yes.
this stuff needs to get out of there. Fear drives people away from a lot. And there's a lot of opportunity in the market that we're in right now. Rates are high. Who cares? You're going to get a huge interest tax deduction at the end of the year, but let's budget it, right? Let's budget and see exactly how we're going to make homeownership affordable, and taxes is definitely a way to do that. So thank you so much, Florence. Thank you for joining. Jamie, thank you so much. And much love to you all. We are going to post this on our YouTube channel. If you have questions, just hit us up. Everybody have a blessed evening.
Have a good night.